Well, GameStop's crazy ride, it continues as Robinhood faces the wrath of Redditors and users looking to get in on the action, and regulators too, perhaps. Joining us now, Michael Pachter, Managing Director of Equity Research at Wedbush Securities. Michael, good to speak with you as always and get some of your insights. I've been following them throughout the week. GameStop shares spiked again today. What is your assessment of the situation, and do you think other areas of the market should be concerned with what transpired with this stock?
Yeah, I want to go back to the prior guest because I think he said the right thing. The market goes up every year. I mean, it doesn't go up in a straight line, but over the last 60 or 80 years, the market's gone up 9 or 10% a year. If you gamble in a casino, you are guaranteed to lose 3 to 4% of your wager, and that's just how casinos work. The house has the odds in its favor. In the market, the investor has the odds in his favor. He's going to make 9 or 10% if he just stays invested. So I don't consider this a casino at all. Now we can talk about GameStop specifically, and I think that the insights on Wall Street bets that we the 2 million and now 6 million person community are going to stick it to the shorts, and we're going to look at the most heavily shorted stocks, and we're going to drive the price up and force the shorts to cover. That's pretty sound. I mean, it did work, and it is a pretty smart strategy until the shorts say, oh, well, we can't do this anymore. We're getting out of the way. And you're never going to get rid of short sellers. Short sellers are necessary to keep the market efficient. They're there to find companies that are actually overvalued and get them back to the right price. But in the case of a GameStop, the shorts are like the Capitol Police trying to hold back the Capitol insurrectionists. They're just overwhelmed. And even if the shorts are right, that GameStop is overvalued at $200, $300, $400, they're not going to keep the mob from doing what the mob came to do, which is drive the share price up. So dynamically, you just have more buyers than sellers, and that takes the share price up. And I think the day trader speculation that, hey, I can buy it at $150 yesterday and sell it for $300 today, that's pretty appealing. And it works as long as there's a new person coming in to buy it from me at $300 and somebody buys it from them at $400. We'll see how long that lasts.
Michael, a few things within that, and I want to start with where you left off with the short sellers particularly, because what we've seen most recently just today, Citron Research saying that they're going to stop publishing their short reports. And so I thought that was very key in how they said it, that they're going to stop publishing. That doesn't mean that they're going to stop shorting. And so what would you expect their activity to look like, either from Citron or from some other firms that are known to short their positions? And ultimately, with that, there's kind of different theses to them all. It could either just be a flat out hit job, or it could be something that is based on some type of fraud that's taking place within the company, just as we were talking about last summer as well with Nikola and what Hindenburg Research was alleging of them not actually having the research and development that had been put into prototypes and things that they actually owned, even as they were going out to pitch investors.
Yeah, there are different types of short sellers. Some look at fundamental value, and so they'll look at a stock and say, "Gosh, Netflix at 500 is overvalued." But you kind of get why consumers, investors believe Netflix can go from 200 million subscribers to 500 million. You get why investors think Tesla can go from 500,000 car sales to maybe Volkswagen level of 10 million. I mean, you understand how that's possible, because someone else has done it.
Right.
It's hard to justify stocks like GameStop because, at $300, $400, you're talking about $15, $20 a share in earnings for a company that consensus is they make $1 next year. I mean, it's just, Ryan Cohen's great, but he's not going to take earnings up to, a 20% net margin. It's just not going to happen. So short sellers tend to look for frauds, but again, this gets too expensive for them to tolerate. I'll tell you the catalyst that's going to take the stock down. I mean, there are two. One is if the company were to pre-announce earnings, and they can't do that until Tuesday. The quarter has to end, which it ends Monday, and then announce that they're going to issue equity. And it depends on how they do it, but mostly they have to issue equity to institutions. Think about it if you're an institution. If the company says, we're going to do an at-the-market transaction to raise several $100 million, you're very comfortable shorting the stock at 300 if you know you can buy it back from the company at a discount the next day. So the company announcing that is going to set the stock up to go down. And I don't know that they're going to do it, but they can. So that's catalyst number one. Catalyst number two is once they pre-announce earnings, insiders, the board and the management, no longer have material non-public information, which frees them up to sell. And so when Ryan Cohen, if Ryan Cohen were to sell his shares, I think that the bull thesis on GameStop to the moon, to infinity, kind of goes away. You have to ask Ryan Cohen, if you can get him on the show, what was his exit price when he bought 8 million or 9 million shares at $8? And the answer is it wasn't 300 or 400, it was 30 or 40. So, he's so far in the money right now, it's hard to see that he's going to continue to be a holder at 300, 400, 500.
Yeah. I think you just asked Ryan for us, so perhaps we'll just follow up after this. As I've been continuing to follow some of your thoughts on just the activity that we've seen from the trading platforms themselves this week, I kind of want to bring that to our viewers as well, because I think it's really notable that we've got analysts like yourselves that are coming to the defense of the retail investors in this environment. And I just want to get your perspective on how you've seen this all play out and what needs to take place from here.
I got my first death threat on Twitter in 7 years because someone said, quit talking about GameStop or I will come to your house and kill you. Unbelievable. And yes, I actually think that things like Robinhood and Wall Street Bets are super healthy for the market. You want to bring as many people into the market as possible. Over the long run, all these people are going to make money if they learn to invest wisely. And I don't think it is up to a trading platform to protect an investor from himself, assuming the investor is an adult. Any more so than it's Vegas's responsibility to tell somebody not to put, $1 in a slot machine because they're likely to lose. It's like, let them do what they want to do. Now, my understanding is that Robinhood actually had to suspend trading because of liquidity concerns. That's what they said. And, so who knows? I'm not sure they were actually trying to ban trades, but they got so much negative feedback from their community that they reversed their decision the next day.
Is that something that you've seen or heard from a trading platform before?
I'm sorry. I follow a ton of trading people on Twitter, and I read one of the smarter guys that I follow said this is a liquidity issue. The prime broker kind of limits how much volume, and apparently Robinhood, because they have to commit capital to get these trades executed, trades don't settle instantly. So they have to commit capital, and they ran out of capital. So that's, again, because the volume spike was something they couldn't handle because it's so unusual. I don't know if that's true. We saw all sorts of rumors that the hedge funds were in cahoots with Robinhood and they were ordering them to do something, nefarious so the hedge funds could cover. I don't actually believe that, but I don't know. Sure. What I do know is that, a trading platform should not tell an investor that they can't make an investment in a normal and publicly traded stock. I mean, I understand private raises that are unsuitable for regular investors, but not GameStop. I mean, anybody should be allowed to buy a share of GameStop.
I think that's good insight for us to have as well, and appreciate the explanation there. Just lastly, while we do have you, the SEC is getting involved, we do know, saying it's going to review the recent volatility. Who's most at risk here?
If there isn't fraud, I don't think anybody's at risk for anything other than the investors are at risk for the capital they've invested. I mean, it can go down. I am not, not that I've read every post on Wall Street Bets, but the stuff I'm reading there is public information. It's like, hey, GameStop has 100% short interest, and if we make the stock go up, they will cover. That's all true. That's a reasonable thing to say. I don't see anybody saying GameStop invented a cure for cancer and they're about to release it and the stock's going to go to 10 million. That's not going on. So no fraud. I don't see fraud. And I think the SEC can enforce regular orderly markets, which allows them to do things like suspend trading in the stock for everybody. But I don't think you can target individual investors on Robinhood and say this is wrong. So I expect nobody's at risk. If there is a Wall Street Bets moderator, you guys mentioned Martin Shkreli, who does something fraudulent, then they will be prosecuted and go to jail. But I'd say the vast majority of the people are just exchanging ideas and they're saying things that are largely true. And I don't see the SEC coming down hard on anybody.
Michael Pachter, Managing Director of Equity Research at Wedbush Securities. Great to see you as always,
Brad.
Michael. All right, guys, and coming up.